Capital moves in a continuous, high-frequency stream. Millions of digital endpoints process transactions simultaneously, yet these networks operate entirely in the dark, isolated. We exchange trillions of dollars in alternative assets every year. The volume is immense, but the verification of trust remains fragmented. Cryptographic networks maintain perfect records on their own ledgers, but those ledgers do not speak to one another. A universal cash hub connecting these isolated systems cannot simply be coded into existence. Code alone lacks the legal jurisdiction to settle actual fiat currency. To safely bridge alternative assets to traditional fiat rails, decentralized networks require a regulated sovereign anchor. This anchor is the sponsoring financial institution, or SFI. It operates as the singular legal bridge capable of pulling value out of the digital ether and depositing it firmly into the traditional banking system. The SFI carries the overarching regulatory burden. It holds the master accounts, defines the exact legal perimeter, and absorbs catastrophic risk. Cryptographic security at the edge lacks a path to the banking system without a legally binding settlement anchor at the core. Financial trust operates as a downward-flowing hierarchy, relying on regulators at the apex. The regulator grants the sponsoring financial institution authority to establish legal boundaries for programs beneath it. At the center of the SFI's ledger sits the omnibus account. The omnibus account is the master pool where actual fiat funds are legally held. It abstracts individual user balances recorded on the network edge. The immediate engineering challenge is routing millions of disparate programmatic transactions from fintech partners back into this singular master account. The SFI manages this traffic by executing strictly controlled bank identification number, or BIN, routing, physically connecting external APIs to the central fiat ledger. This technical routing grants the SFI complete gatekeeper status. Every dollar entering or exiting the traditional banking system must pass through these specific corridors. Through this architecture, the SFI mathematically calculates and enforces the strict, non-negotiable fiat float limits for the entire extended network. No partner program, regardless of its independent code, can process a single dollar beyond what the SFI explicitly allocates within that float parameter. Ultimately, the SFI's clearing topology establishes the physical limitations and legal borders of the entire programmable financial system. Zooming in from the macro network down to a specific node reveals the daily forward motion of fiat settlement, bridging alternative assets to a local merchant's physical register. Settlement requires delivering actual, stendable cash to the merchant based on the transaction data generated by the network. Decentralized networks inherently contain physical and operational failure points at their extreme edges. A localized merchant may default on its obligations, or the physical register could experience a theft event. When an edge node fails to deliver the promised fiat, the system must immediately determine who absorbs the resulting financial damage. To manage this, the SFI deploys a programmatic liability distribution matrix to act as a rigidly predefined legal safety net. The merchant acquirer absorbs the primary, immediate loss. They assume this localized risk in exchange for bringing the physical endpoint online. The network operator holds secondary liability if the failure resulted from improper routing or a breakdown in systemic transaction authentication. The sponsoring financial institution remains insulated, stepping in as the ultimate backstop only if the failure threatens the core omnibus ledger itself. Without this rigidly enforced matrix dividing risk across institutional players, the settlement guarantee for the end consumer lacks a structural mechanism for solvency. In this architecture, physical merchants operate as authorized cash handling agents. They form a branch-light network, where every physical register acts as a highly localized micro-extension of the SFI's banking license. Applying a flat, universal rulebook to these micro-extensions introduces massive systemic vulnerability across diverse geographies. To mitigate this, the SFI abandons flat rules in favor of dynamic, tiered merchant risk ratings. The system constantly evaluates multiple variables, primarily the localized risk density associated with a specific zip code. It then factors in the precise industry code of the merchant, distinguishing high-risk, cash-heavy businesses from low-risk retail environments. Based on these combined inputs, the algorithm enforces strict maximum daily limits for cash injected into the system at that specific node. Simultaneously, it throttles the maximum daily cash-out velocity, preventing sudden liquidity drains from high-risk locations. These dynamically adjusting boundaries form the essential primary operational guardrails, completely insulating the programmatic network from localized fraud attacks. Intelligent risk management applied directly at the physical edge guarantees that localized contagion never reaches the central omnibus accounts. Legacy prepaid architectures rely on rigid one-way pipelines. They utilize static know-your-customer checks. The system verifies an identity once during onboarding and assumes perpetual trust for all future transactions. Modern networks require programmable digital identity to maintain security. Data streams simultaneously in a continuous bidirectional loop. While the fiat money moves forward through the clearing topology, continuous risk telemetry must stream backward from the edge. Programmable identity uses cryptographic attestations to verify users, eliminating the need to transmit raw, vulnerable personal data across the network. This is achieved through zero-knowledge proofs, which allow a node to mathematically prove its trustworthiness to the SFI without revealing any underlying sensitive information. These zero-knowledge attestations constantly ping the SFI, requesting real-time authorization before any settlement protocol can trigger. By implementing identity as a bidirectional signal, the SFI can instantly sever trust the exact millisecond a risk parameter is violated, regardless of initial onboarding. When a failure event occurs out on the edge, the system response is instantaneous. An identity signal fails at a localized node. The bidirectional protocol registers the anomaly and triggers a network-wide system denial. The zero-knowledge proof recalibrates the risk boundary in milliseconds. It cuts the compromised node off from the omnibus account before any settlement funds are exposed. In a highly decentralized digital economy, the central question remains: who truly decides who is trusted? The sponsoring financial institution. Without its centralized clearing topology and specific legal mandate, the network instantly fractures into unregulated, high-risk silos. Interoperability and scale at the decentralized edge only function when firmly tethered to a centralized, highly regulated sovereign anchor.